Financial fraud is often committed by family members, especially when it comes to elder financial abuse, as shown in a recent Dear Amy column in Michigan Live. And it reads in part, "Dear Amy, I'm wondering if I should intervene for a friend and a neighbor who appears to be taken advantage of by her daughter and granddaughter. Shortly after Max passed away 7 years ago, Edna divorced unemployed daughter Lara moved in with her. Now Lara's unemployed daughter, Edna's granddaughter, has also moved in and brought her 4 young children. We've seen this played out time and time before. The neighbor says the last time I saw her, she was crying and said that her daughter and her granddaughter are sponging off of her, spending her Social Security, and because the unruly children are allowed to scream, fight, and wail incessantly, she's had to give up her piano lesson clients, so that hurts her income. She also added that her daughter has talked her into a reverse mortgage so that she and her granddaughter can have access to, yes, even more of her money. Edna says that she feels like she's a prisoner in her own home. So the neighbor provided advice. She said, kick them all out. And then added last week, she went over and knocked on her neighbor's door, but the daughter turned her away, saying that Edna now has dementia symptoms and cannot talk to neighbors or go outside of the house. She truly is a prisoner. So Amy answers, dear worried, you should intervene and do so quickly. Just kick them out is not as practical as one would consider when the abuse has progressed to this point. Edna is trapped, so you should go do a search for adult protective services in your county and report this abuse immediately. I couldn't agree more. Amy also added, I would also call the police and request a wellness check on this very vulnerable elder. Now, this is not being a busybody. She says this is being a good neighbor and a good friend. And cases like this, when it comes to financial abuse, are infuriating, but unlike what the media portrays, most of them do not come from financial or mortgage professionals. They come from their own family members. Aging in place doesn't have to be a shoestring operation, at least for some older homeowners. An article in the Associated Press reports that some older Americans are now splurging when it comes to home improvements and adds that staying put is becoming less of a choice for many. Some baby boomers and older members of Generation X are locked into low mortgage rates that are just too good to give up, we understand. And skyrocketing housing prices fueled by lean supply further complicate the calculations of moving or downsizing. With the vast majority of those that are 50 and older saying that they want to remain in their home as long as possible, well, renovations and modifications would become more commonplace and necessary. Brenda Edwards considers the 4-bedroom ranch-style house where she has lived for over 20 years her forever home. So she hired an interior designer for $20,000 and spent another $95,000 to retrofit the house in Oakdale, California. The bathroom, it now has a walk-in steam shower and an electronic toilet seat that cleans when the user has activated it. We have a pool, we have a spa. We just put a lot of love and effort into this yard. We want to stay. And that is just another reason why most are unwilling to move. These modifications to age in place have exposed the divide that exists between those that are well-heeled with much money and lower-income boomers and their ability to age in place. There are all these options for those people who have a lot of money, says Jennifer Malinsky, director of the Harvard Joint Center for Housing Studies. But she adds, but there's a lot of disparity. There are people, through no fault of their own or for systemic reasons, who may not have the money to modify their home. When it comes to those with little money, Kathy Perkins is one example of one who found help. She has chronic fatigue syndrome, but a local nonprofit group modified the first-floor apartment that she owns in Beaverton, Oregon. Those changes, which cost about $3,000, included replacing her tub shower with a walk-in version and also installing a higher-seated toilet. Now, the demand for inconspicuous safety bars, lower sinks, and residential elevators and other amenities has given home improvement chains, contractors, and also designers and architects a noticeable lift. These aging-in-place modifications are having an impact. Home Depot, the nation's largest home improvement chain, is now revamping their Glacier Bay brand to include sleeker grab bars and faucets that are easier to use. Lowe's has created a one-stop shop in 2021 that offers wheelchair ramps, teak shower benches, taller toilets, and other products that are geared toward older boomers who are looking to modify their home to age in place. A recent column in Yahoo Finance points out why more older Americans are more likely to be rejected when applying for a mortgage loan. And for most Americans today, especially the younger adults, home ownership is just simply out of the question, with home prices that have skyrocketed and mortgage interest rates that have more than doubled in recent years. In fact, today's mortgage rates are the highest that we've seen since the mid-2000s. Then there's stagnant wages and growing debt that has crowded out most other forms of spending and saving, which makes it difficult for many to come up with the required down payment. But waiting to purchase a home until you're older could also cost you more. And here's why. One Federal Reserve economist noted in a recent brief that older mortgage applicants are significantly more likely to be rejected when applying for a loan than those that are similarly situated but younger. The Federal Reserve economist also notes that loan rates increase steadily with age, and they peak for new borrowers over the ages of 60 and 70. The difference of the interest rate, however, is less pronounced, as lenders charge older applicants modestly higher interest rates, while they reject older applicants much more often. But both trends are still very real. While it seems that mortgage lenders consider older borrowers a greater risk due to the issues of income and mortality, home buyers should note that under the Equal Credit Opportunity Act, it is illegal for a lender to deny loans based on age or age discrimination. But there are two exceptions to that rule. The first exception allows a lender to account for age as long as they do so in favor of the applicant. Now, this is a relatively commonplace practice in discrimination laws, which typically allows direct consideration of age as long as it benefits the older individual. However, it is the second exception to make a loan decision based on age that can seriously hurt the chances of an older mortgage applicant. Now, while lenders are not allowed to explicitly consider an applicant's age in the mortgage process, they can relate age to other permissible factors in underwriting. For example, a lender may consider just how close a mortgage applicant is to retirement or what the mortality risks are involved with that particular loan. They can also consider factors that typically correlate with age, such as whether someone will repay the loan with the returns from an investment portfolio, which that investment portfolio is not guaranteed, and that could create a problem for many older borrowers. According to the Federal Reserve, adults in their 60s and 70s own about $70 trillion in collected assets. Yet baby boomers' wealth is increasingly concentrated in assets rather than income. And many retirees live off investments such as 401ks or IRAs and the wealth in their home if they use a reverse mortgage or a home equity loan. For lenders, this creates a credit risk. Portfolio drawdowns are not a basis to reject someone's loan, but they do make credit analysis more complicated than with a structured W-2 income. Lenders generally treat an investment portfolio as a less predictable source of income with which to pay the loan. And this can make more banks more likely to reject loans from retirees and more likely to treat as a risky loan if they do approve it. All of that creates an atmosphere of risk around older mortgage applicants. The column concludes stating that if you're 62 or older, you're almost 30% more likely to get rejected when applying for a standard or traditional mortgage. That concludes this week's episode. Thank you so much for watching. Don't forget we have an audio companion which you can listen to on Apple Music, Spotify, or on Podbean. Be sure to hit the subscribe button when you're watching today's video and the like button if you found value in the content we bring you each and every week. We look forward to seeing you next week for more reverse mortgage news for mortgage professionals you'll only find here at HECMWorld.